All right, so greetings, everybody, and welcome to our first inaugural edition of the Savvy Homeowner Series. I want to just welcome everybody and thank you for joining us on this Monday evening. I know you have other things that you could be doing, but we're glad you decided to tune in and listen to our experts this evening. So, just to tell you a little bit about our mission, the Savvy Homeowner Series is designed to provide timely and relevant information. I know a lot of times people are inundated with information that they get from the news or articles about housing and home ownership and rates and increases and lending and mortgages and all that stuff. So we just wanted to give you a platform where we could come and kind of answer some questions and also just provide some much needed information straight from the experts. So I'm going to be your host this evening. My name's Cheryl Merritt. I am the CEO, broker of New Legacy Realty, and we are a local residential real estate firm located right here in Raleigh, North Carolina. We've been serving clients here in the area for about 30 years. And on today's webinar, we are delighted to have two special guests. I have with us today Karen Boone, who is a State Farm agency owner, and Karen is located right here in the Raleigh area. And I also have Yvette Carpenter, who is a vice president and retail mortgage loan originator with Truist Bank right here in the Durham area. So welcome to them, and they're going to give you some of their background in just a second. But before they do that, I just wanted to let you know what today's topics are going to be. So we're going to be talking about homeowners insurance and also mortgage lending. So at this time, I'll go ahead and ask Miss Karen Boone if she could introduce herself and tell us a little bit about her agency.
Sure. Well, thank you, Cheryl. And again, it is my honor to be here. I always look forward to having a platform to tell people not only about me, but about what I do, because I feel like what I do is such an integral part to generational wealth, building it and keeping it. And that's at the core and the foundation of what we do. I am an agency owner in the heart of Raleigh at the intersection of Glenwood and Pleasant Valley in the Village at Town Ridge Shopping Center. I have been with State Farm for well over half my life, for over 30 years. And I've worked in several different capacities, attorney, claims negotiator. I worked in agency field leadership, and I've been an agency owner for about coming up on 15 years. And one of the things, well, a few of the things that I do, I help my people face a very uncertain future with confidence and without fear, because these are very uncertain times that we're living in as it relates to the weather, as it relates to things that we're paying for, as it relates to even something as simple as car accidents, because there are a lot of risks that are out here just waiting to attack us. And if we don't have the proper things in place, then everything that we work so hard for can be eroded. So I help customers build a wall around what they have amassed and what they want to protect, to ultimately be able to bounce back and recover if life happens, bounce back and recover quickly. And like I said, to help build that generational wealth. And a lot of people don't connect the two things, but insurance does help you build and maintain that generational wealth. My team and I, fully licensed agency in all product lines: auto, homeowners, renters, life, disability, mortgage protection, as well as retirement planning, things like that. And we serve North Carolina, South Carolina, Virginia, and DC.
Awesome. What a resume. Thank you so much, Karen.
Mhm.
Thank you so much. I can't wait to get into the questions that we have for you, and I'm sure you'll tell us a lot more. So, Yvette, if you could go ahead and introduce yourself and your role.
Sure. My name is Yvette Carpenter. I am a mortgage lender with Truist. I have over 25 plus years of experience in a mortgage lending capacity. I would say that primarily what I do is I purpose to inspire and build better lives and communities. And that's just not in certain communities, that's in all communities. And one of my passions is you just have to serve people and meet what their needs are. So what I do is I assist people with purchasing a home, refinancing their home. I consider myself a trusted advisor as it relates to, helping people achieve the dream of home ownership. And I feel like it is a basic right that we should have. Everyone's should have the right to own a home that would be credit worthy. And I try to assist my clients with being able to get to the point where they are credit worthy, and also try to encourage them. It's about creating generational wealth. And as you know, in a lot of ways, the LMI community or the in a lot of communities, we've been left behind in many ways. And so I consider myself a person that wants to help the client to achieve that. And so I'm just here saying, use me, use me, use me. Because, sometimes the help that you lend may not always result in a loan or, revenue or income, but the help that you lend is helping that person get a step closer to really where they want to be. And so, I'm just here to try to be a blessing and help my clients be able to achieve those dreams.
Wow, thank you so much, Yvette. And I tell you, I hear the theme already. Both you and Karen and myself, we are all talking about serving others. And that's exactly why we're here tonight as well, is to be able to bring that information and serve others and give them what it is that they need to help them make, I think, sometimes very, very informed decisions. And so with that, I'm going to go ahead and get started with my questions. And this is going to kind of be interview style, of course, and you're welcome to expound on the questions and add anything you feel. I'm going to start with some insurance questions, and I'm going to start with Karen with that. So, Karen, I know most recently here in our area, there's been some conversations, the news about a 42% increase in homeowners insurance. I know it was currently rejected and that there's a hearing scheduled for sometime in October to discuss it in detail. Can you tell our audience a little bit about what's going on with that and what we can expect, and if there's any insight you can provide to us?
Sure. Well, first and foremost, that 42% increase was requested by the North Carolina Rate Bureau. Here in North Carolina, we operate with insurance a little different from other states. Other states do have a Department of Insurance, as we do, but we have an entity that falls under the Department of Insurance. It's the North Carolina Rate Bureau. North Carolina Rate Bureau, they don't pay claims. That's handled by the insurance companies that are doing business in our state. However, the Rate Bureau, they can look at average claims paid out, they can look at catastrophes in the area, and then they will petition the North Carolina Department of Insurance and ask them for a premium increase. So, as you stated, Cheryl, they have asked for 42%. They won't get 42%. And the reason that I say that is just based on history. They always overshoot and then they come in somewhere which is probably a little less than they want to get as an increase. And it's probably a little more than the Department of Insurance wants to approve, but that's healthy negotiations. So they won't get everything that they ask for, but they are going to get rate. The reason they're going to get the rate is because insurance is not insulated from everything that's going on in the world with inflation. When we had COVID, contractors at that time, when they did get jobs, they were charging a little more because the demand for contractors' work went down. So, in order to support their business, they may have had to increase their rates, which they did. The supply chain shortages with the drywall and the vinyl and the hardboard masonite, the raw material that or the raw materials that are used in home building, those prices have increased because of a shrinking in the market of being able to get those items and then just inflation as it has hit everything from our groceries to our gas to just everything that we think about now, and everything that we as consumers have to buy. So it was on the national news as well as the local news. They did a piece comparing homeowners insurance rates, and they indicated there were two states. I believe Missouri was one of them, and I can't remember who the other one was, who had the lowest homeowners rates. And Florida and New Orleans have the highest insurance rates for auto and homeowners. You have to factor in the weather. So when we have catastrophes, and we have quite a few here in North Carolina because we are a coastal state. Now, we're not bombarded as heavily as Florida or New Orleans, but catastrophes also affect the rise in the insurance rate. So those factors are attributed to the North Carolina Rate Bureau petitioning the Department of Insurance for an increase. And again, they won't get 42%. I'm thinking, and don't hold me to this, but I'm thinking they'll probably get about a 19-20% increase. So we'll just kind of like hold our breath and we'll see what happens with that. But there are things that an individual can do when they're working with an insurance agent and not a 1-800 number to make sure that their premium isn't just skyrocketing out of control, making sure that agent can have a conversation with them about cost per square foot to rebuild your home, have a conversation about replacement cost on your home to make sure that you're adequately covered, making sure that your policy has an inflation guard protector on it, because not all companies offer that. A company doesn't want to overinsure you, but we don't want to underinsure you either in the event something happens, total home devastation, and we have to rebuild. And an individual should probably sit down with their company or their agent every 12 to 18 months. That's what we do with our clients, just to review your coverages, to see if there are any other discounts you might be eligible for, and making sure that we've got that home properly insured for you during these somewhat tumultuous times where everything around us is increasing and insurance isn't insulated from that.
Wow, what a great lengthy explanation. I think we all learned something from what you just said. And that leads me to another question. You talked about catastrophe, and we
Mhm.
know, in recent years, North Carolina has been impacted by a lot of flooding through hurricanes and things like that. I know I personally went to a flood insurance training, probably maybe right before COVID, right around COVID, and they were almost advising everyone to have flood insurance.
Mhm.
What are your thoughts about that around flood insurance, and who should or shouldn't be required to have home flood insurance?
Okay, good question. Now, if you're in a designated flood zone, you're going to have that flood insurance, right? Because Yvette, the mortgage company, they're not going to give you the keys or continue to give you the keys if you are in a designated flood zone and you don't have the homeowners and the flood plan. But let me just start by saying this. An insurance company's homeowners policy is going to cover any weather related event. We call them perils in our industry. Any weather related event or peril that has wind driven rain, hurricane, tornado, tropical storm, tropical depression, anything where the wind is driving the rain, that's going to be covered under a standard homeowners policy. Now, flood, if it just rains for 40 days and 40 nights and the meteorologist does not say it is a named storm, a hurricane, a tropical depression, anything like that, a tornado, then, and the water rises and comes into our homes, or the weather related event has moved out of the area, as it typically does in North Carolina, and it'll go up the coast or it'll go down east, and then it just has the rain with it. And the creeks rise, the streets swell, the yards swell, and that water comes into our homes. That's a flood. So I could never sit here and say one does need a flood policy or one does not. I could say they need it if they're in that designated flood zone, but I would encourage customers, if they're not in a flood zone, just look at what happens to the streets when you just get days where it just rains. Is there a creek behind your house that has the propensity to rise? Does your land get saturated? Do you live in an area like near Crabtree Valley Mall where it can flood if we have torrential rain downpours for multiple hours or multiple days? So I would encourage the homeowner to just take a look and see what happens to your street, what happens to your neighborhood. And it won't hurt to get a flood quote that's provided through the insurance company, but it's underwritten by the NFIP, National Flood Insurance Program, or FEMA. So just as a side note, they're going to give you coverage for 80% replacement. They don't cover at 100% replacement. And most insurance policies should give you coverage at 125% replacement cost. I know we do, to give you a buffer, give you an additional 25%. But going back to that flood quote, it's going to cover 80% replacement cost of that home. That premium is due one time per year. And whenever you put it into effect, there's a 30-day waiting period before you actually start getting the coverage.
Wow. See, and that's good to know. That is, I don't think most of us, I know I didn't know that. Number one, that there's a 30-day waiting period if you
Mhm.
get the flood insurance. And then two, when you talked about the wind, how that is covered as a peril, but if the
Right.
water's coming from something else. So thank you for that. Now let me ask you this, and I'm sorry.
Oh, I said sure.
Oh, okay. So let me ask you this. If a person is in the process of renovating their property or making any improvements to their home, is there anything they need to do regarding their insurance?
If you're doing anything to your home and you're adding square footage with a room or an addition, you definitely need to engage in dialogue with your insurance agent, because one of the main features of a homeowner's policy is to cover that home for replacement cost. And that's based on cost per square foot. And that insurance company and agent should be able to explain to you that a homeowner's policy, it's not going to cover the land. So that's not going to be factored in the amount of coverage that we give you. It's only for the dwelling or the structure itself. So if you're adding square footage, you definitely need to talk with your insurance company. If you put a new roof on it, if you change the heating system or the electrical system as far as upgrades or the plumbing, let your insurance company know, because then they need to communicate with underwriting. Yes, this house may have been built in 2018, but they upgraded the heating and the electrical system in 2024. So the premium will probably be adjusted at that next renewal. So you have to engage in dialogue with your insurance company, let them know. If you have any questions, you should be with a company that you can just call and say, I did XYZ to my home, or I completely gutted my kitchen and I added, my kitchen was a $35,000 renovation project. Then just talk with your agent and find out, or communicate to the agent, we have marble countertops. We did quartz or granite or things like that. And let that agent do a new estimated replacement cost, adding those features and benefits in to see if the dwelling coverage that you currently have is adequate or if it needs to be increased. But like I said, if you're doing anything that adds square footage, or even if you put in an in-ground swimming pool or a gazebo, or you enclose your deck, yeah, it's always good to just have communication with your agency team so that they can give you the proper guidance and make sure that you have the proper coverage.
Okay, all right. Well, I appreciate that, and I'm sure our audience does as well. And I have one
Mhm.
final question for you, Karen, before we move on to Yvette and lending. So, are there any recommendations that you can provide to our savvy homeowners that they can use to help mitigate any potential risk or improve their home safety? And an example I'm going to give right now is like solar panels. I mean, is there anything that they can do to mitigate risk or um, improve their home safety?
Well, solar panels, they are going to be covered under the policy under the other structure coverage that you typically get. I would encourage savvy homeowners to at least make twice per year, go out, look all around your house, look at the fascia boards, look at the vinyl siding or the hardboard, or look at the bricks, and make sure that everything is where it needs to be, and there is not any indication of weather related damage. So as far as any type of mitigation goes, just make sure that your pipes, your plumbing, everything is where it needs to be, because you don't want to have any sudden bursting of the pipes, even though we know that's covered. But as a homeowner, just check your main systems. Make sure that your hot water heater, look at that hose, look at the hoses that are connected, anything dealing with water, the hoses for your dishwasher, for your washing machine. Just make sure that those things are not deteriorating, or they need to be replaced, because a lot of times items in our homes that are subject to wear and tear, they may deteriorate to such an extent that they burst or what have you, or the hot water heater explodes because it's old. The insurance company doesn't pay for that particular item, but will pay for the resultant damage. And there's a lot more information that I can give you on that. I sit down with my customers who are those savvy homeowners, Cheryl, and we have these conversations so that they have a very good understanding. But I've given you, I guess, like a 50,000-foot high level overview. But the bottom line and what resonates and a common thread should be: engage in dialogue with your agent, and make sure you're meeting with your agent or your insurance company. Make sure that if you don't ask for the meeting, make sure that company is exercising their due diligence and asking to meet with you as the savvy homeowner every 12 to 18 months.
All right. Well, thank you so much, Karen. Thank you for
Mm-hmm.
that wonderful advice. And I'm sure all of our savvy homeowners will be taking it and making contact with their insurance agent. And of course, we're going to leave. When we leave, we'll make sure we give them your contact information. Before I move on to Yvette, you're welcome. Before I move on to Yvette, I just want to welcome one of our guests, Timbuktu. So, welcome to the Savvy Homeowner Series tonight, Timbuktu. Thank you.
Thank you
All
so
right. So, Miss Yvette, our lender here, some questions for you. So, as I mentioned when we got started, a lot of people are paying attention to the news and, what's going on with mortgage rates. So, can you just give us an overview of what's going on in the market right now when it comes to mortgage rates?
Sorry, mortgage rates have increased. And of course, we know that they're up from, where they started during COVID, and that was like a 40-year low. And, everybody, when mortgage rates started going back up, it was, doom and gloom, and it has been harder to, especially for first-time home buyers. But I do feel very optimistic about interest rates coming back down here after the first quarter of 2024. Currently rates sit around maybe 6.5, 6 3/8, but there is a very heightened desire on behalf of just the industry as a whole. And we believe that the Fed will reduce the rates. And the speculation is that it will be at least 3 times in 2024. And I think that will bring a lot of buyers who, went off the market, and they're kind of trying to ride it out and see what happens. I think that will bring some of the buyers back to the marketplace. And of course, when rates are lower, it's easier to get buyers qualified. In this environment that we're in right now, you have many sellers that are sitting on their houses and just continue, choosing to stay simply because they may have a 3% interest rate, they may have a 4% interest rate, and it's very hard to convince that buyer or that seller to, buy another house, and now they have to pay 6.5, almost 7. We saw rates go up and edge up to almost, 7.75, almost 8%, within the last 6 months. So, there's a lot of sticker shock associated with that. And so with the Fed, inflation, has somewhat kind of leveled off. Job numbers continue, we continue to gain jobs. Earnings, are higher. So I feel like there is a strong sense that the Fed will come back in and reduce the rates, the prime lending rate. And I think we will see some relief in rates within probably the second quarter of 2024.
All right, savvy homeowners, you heard that. Second quarter of 2024, we may see some reductions in the mortgage rates, which will be great news. One of the things you mentioned, Yvette, is how much equity these current homeowners are sitting on and how they may be not willing to give up their 3.5 or 4% interest rate for what we currently have.
Mm-hmm.
But can you talk a little bit about the advantages to having that kind of equity in your house? Specifically, are you seeing any refinancing going on? Well, you won't be right now because of the rates, but any like home equity lines of credit. That's one of the things I wanted to kind of chat a little bit about this evening, because even though people may not be willing to quote unquote sell, I know one of the challenges that we've been seeing with the higher interest rates are everybody is using credit cards for and getting more debt, and a home equity line of credit is a lot cheaper than a credit card. So can you speak a little bit to that for me?
Sure. The average household is sitting on anywhere between 100,000 to 150,000 in equity based on the appreciation rates that we've experienced within the Triangle area. I mean, really, properties have appreciated. So homeowners are sitting on a lot of equity, and that equity, even if you don't want to touch your first mortgage, the home equity line of credit, it is indeed a second mortgage that you can utilize to pay down debt, to pay down credit card debt. You can use that to finance your children's education. You can use that for home repairs. And typically a home equity line of credit, which primarily home equity lines of credit are only used on your primary residences. And, I know there may be some lenders out there that will do it on investment properties, but primarily where I see it is on the house that you're currently living in. And I have specific examples of where you can look at someone putting in a home equity line of credit. Typically, the fees and the costs associated with establishing a home equity line of credit are minimal compared to going through a whole new refinance. And, you can probably put it in a home equity line of credit for less than $500. And they have been able to, for say you initiate one and you get a 75,000, you can pay off 3 or 4 credit cards, pay off a car, and your monthly payments can be $1,100 to $1,200 less than what you're currently paying. The average interest rate on a home equity line of credit, depending on credit score, is going to be around 8.74, maybe 9%, maybe max. But if you look at where credit card rates are right now, I'm seeing 23s, 22s. I mean, credit card rates have really went up, and especially if you're carrying a balance. If you're carrying a balance on those credit cards rates, you're really just paying interest. Very seldom am I seeing people that are just really, paying over and above what the minimum payment is because the rates have went up so high that has affected their budget on a monthly basis, that it's all they can do to just pay the minimum payment. So the home equity line of credit is a great avenue to try to reduce that monthly outgoing cash that you're paying each month and still be able to have the potential to write that interest off on your taxes.
Well, see, that's information that all of our savvy homeowners needed to hear tonight. So just make sure I understand. They could take their credit card debt, roll it over into a home equity line of credit, and possibly save hundreds and hundreds of dollars just because the difference in the interest that you're paying on your credit card or your car payment versus what you'd be paying on a home equity line of credit.
That's exactly right. And what I always suggest is, write down the monthly debts that you're paying, include your mortgage, include all the payments that you're paying on your credit cards, any personal loans that you have, any auto loans, and then add up, and then we'll calculate the payment on the home equity line that you would have, and see what the monthly cost savings would be to you. Now, keeping in mind that I just always have to suggest, anytime you're pulling equity out of your current home, it is very important that you look at how much time you plan on staying in that home and making sure that there's a cost savings there, but also making sure that if you are living on credit, that you change your spending habits, that you realize, because what you don't want to do is take out the home equity line of credit, get a $75,000 line, and then recharge your credit cards back up. I think it requires you to truly look at your budget, truly look at what got you into the situation to where your credit cards are where they are, but then also, try to change the spending habits and trying to change those behaviors so that, that your equity, that you're not eating up into the equity of your home just to be right back in that same situation as what you had.
Yeah, so that's priceless advice right there because I think we all know sometimes that happens. A person may use some vehicle to pay off debt and credit cards, and then they turn right around if they haven't changed their behavior patterns. So, are there any resources out there to help with the behavior change? I mean, I know there's financial literacy workshops and things like that, but anything that you can recommend to a savvy homeowner to help them if they need to make a shift in the way that they've been handling their budget?
Well, there's a lot of resources like DHIC in Raleigh and SESI, which is Consumer Education in Raleigh. There's a lot of, and even there's a lot of online apps that you can do and put your debts in to make sure you know where your money is going. But there's also a lot of credit counseling and budgeting tools that you can use to try to help you set a realistic budget and also to try to help you develop a savings pattern. Because a lot of times I think what people do is that, the things that you want to do. You may know that you want to go, on vacation once a year and you want to take a big trip, but there's ways that you can do to help you save for that in advance, as opposed to putting that on a credit card and then coming back home and you still have that debt to pay. Same thing with Christmas. So there's a lot of budgeting tools that you can use that will help you try to develop that budget. But then it's also about self-control. You making sure that you stick to that budget and making sure, because ultimately the goal is financial independence. You want to be able to have that financial independence so that you are not relying on those credit cards, and that you are saving and that you have emergency funds. And I think that just gives you more power over your life and over your finances so that you don't have to rely on those credit cards. And you're not relying on credit cards. When the interest rate goes up, then your payment goes up. So I think, just practicing those good stewardship behaviors will help you to stay true to your budget.
All right. Great advice. So a lot of our savvy homeowners, sometimes they have only purchased one home and have not purchased maybe in the last 10, 15, 20 years. So can you tell us a little bit about what the loan process looks like if a homeowner decides they want to sell and then they want to buy another house? What would that look like? What kind of documentation would they be required to bring to the table? Just a little bit of advice there for us.
Yeah. So things, have changed. Credit has tightened up, now that interest rates have increased. So I would say the first step you always want to do is get in front of your lender so that they can let you know what your level of affordability is. And then just the same kind of documentation like your W-2s and your pay stubs and even if you're self-employed, making sure that you're looking at your tax returns because we do need 2 years of tax returns for self-employed income and we want to take an average. So the documentation hasn't really changed very much. It's just that, again, we're basing your level of affordability on the debts that you're carrying. And I also suggest if you think that you want to sell your house, start 6 months prior to, start 6 months prior to that, looking at your budget, looking at your financing, looking at what you have in savings, and then talking to that trusted advisor to make sure that your goals and objectives align with, you know, meeting with that realtor, making sure that they understand, is this a lateral move? Can you afford that increase in your monthly payments? Is it, can you get the same square footage that you are accustomed to? Because sometimes it's a matter of, a lot of sellers think, oh, well, if I sell my house and I have this much equity and I can walk away with this amount of money, you would be surprised that sellers that once they become a buyer, they understand the cost of construction has went up. So they're very surprised that it may not be that you're going to go up 500 or 600 in square footage. And so it's really just starting early in the process, getting the documentation, looking at your credit, making sure you are where you think you are, or if there's things that you need to address, so that by the time you get to that point where you're ready to put the house on the market or you're ready to purchase, that you'll have a great home buying experience and there will be no surprises or gotchas.
So that leads me to another question because, we have both fixed rates and adjustable rate mortgages. And I know a lot of times people may shy away from an adjustable rate mortgage. Can you give a little bit of insight on when an adjustable rate mortgage might be a viable option for someone?
So typically, if you will be staying in the home for at least 5 years, I would say an adjustable rate mortgage may be, or if you know that you'll probably move within 5 years, 5 to 7 years, then an adjustable rate may be the option that you want to take because typically adjustable rate mortgages, the rate is about, anywhere between a quarter to 3/8 lower on an adjustable rate. And so it does lend itself to a lower payment. But what we are finding now is that the adjustable rates, once the prime rate gets so high that, anything after, like if you do the difference between a 10-year and the fixed are exactly the same. So there's no real difference between a 10-year adjustable and the 30-year fixed. So for an eighth in rate, most people will pick just a 30-year adjustable and just go with that all day long. Where you get the biggest difference is usually in your 5 to 7-year adjustables. And we find typically, adjustables are really only for those folks that, like even right now, if you thought interest rates were going to be 2 or 3% lower within a 7-year period, then you might consider an adjustable because you feel like interest rates are going to go back down. But I can say that I don't know if interest rates will go down to the level that they were at when people were receiving 3%. So it's always a good idea if you do take an adjustable, you want to start looking, anywhere between, if you do a 5-year, you probably want to start looking at 3 to see what the market is doing. If you've done a 7-year adjustable, you probably want to start looking at 5 just to see what the market and what the general rate environment is, because at 5 or 7 years, you will have to do something with that loan, so that it doesn't adjust on you.
All right. Well, thank you for that information. I'm sure our savvy homeowners got something out of that. And what I want to talk about now is just a little bit about um, the market itself. And one of the things I've been seeing, and I want to get you all's input from this as well, especially you, Yvette, too. Have you still been seeing where there are a lot of investors in the market purchasing homes?
Oh, yes. Yes. There are companies that, well, and what I'm saying is a lot of investors are coming in just for rental purposes, to rent the homes, not necessarily, not necessarily to for home ownership, but it's more for rental purposes. And I think that's a function of all of these companies that are coming to the Triangle area. And I feel like they, they know that, there's no more land. And what's going up right now is a lot of apartments, a lot of townhomes, but you're not actually seeing a lot of actual homes being built, especially if they're very, 0 lot lines. And so a lot of it is just investors wanting to rent as opposed to trying to resell for home ownership, which is boxing out a lot of the first-time home buyers.
Any thoughts on that, Karen?
I mean, I have seen an influx of my customers amassing investment properties and just homes to buy that they can fix up and they can rent out for a little while, having a rental dwelling policy, make some money off of it, and then maybe flip it or get it to flip. So I have seen an increase in investment properties lately. And a lot of my customers well, they were up until January. A lot of them were refinancing. Not as many now, Yvette, but a
Right.
customers were refinancing to capitalize on some savings and maybe even doing that bill consolidation or debt consolidation. We had a lot of that. We saw a lot of that because they've got to get a new declarations page. So that's how we know. And we get contacted by the second mortgage company.
Right. And in the summer, like of 2023, before the rates were pretty much at their highest, a lot of people were renovating their homes. They were looking at what they could get out on the open market for new construction. And they were comparing that with what they already had. And they said, okay, I'll just fix up what I have. I'll renovate what I have. I'll make my house like brand new. And so they were staying put. So when you have a market like that, you have very low inventory. It just makes all the other houses that come on the market that much more in high demand. So, but I mean, truly right now, it's about the rents, I don't feel like have went down at all. So it is truly, if you have property that you can rent, you almost have the golden ticket right now.
Yeah, I wanted to ask that question because I've, as a real estate professional, I've, get listings, and I just got a listing not too long ago, and I've been inundated with offers from investors. And it's just, and not just this listing, it's even last year, as you were mentioning, Yvette, just with the listings that we had, a lot of them were, especially if they're priced, under $400,000. I'm gonna use that number because the median price right now is around 450 in our area. You know, it was just like so many investors, and then even clients I have who are telling me, clients that I'm working with who are talking about putting their houses on the market, um, how they're getting letters and phone calls from
Mm.
investors almost weekly.
Oh, it's daily. I mean, 3 and 4 phone calls, and these are truly, they hire people to just shop the neighborhoods, just shop the neighborhoods, and they're relentless. You block them, and then all of a sudden they call back again using a different number. But it really is, they're just looking to see if they could buy your home. And a lot of it is just for, it's for investment purposes.
And how do we feel? Because I can tell you how I feel about that. Because I feel like, number one, there's an assault on home ownership. Um, because when you have that many institutional investors and even private investors, I don't want to sound like I, have some kind of disdain or anything for investors or people who want to have rentals, for a part of their portfolio, because I don't. But I'm talking about when you have, institutional investors who are being funded by big companies.
Private equity
Yes,
companies, yes.
yes. When you have investors who are being fueled with so much money coming into the market to buy these houses. And I was reading an article the other day where, they are like, we want to buy another, 50,000 houses across the country in 2024. And I'm like, wow. So I can only imagine that, the same way I said some of my potential clients are saying they're getting these phone calls and these letters in the mail, that all our savvy homeowners are getting the same stuff, right?
Mhm.
Especially if you live in a decent neighborhood, a decent community. These investors are really, really, putting pressure on those homeowners. Um, so I just wanted to say that. Any other final thoughts on that?
Well, I would just say that it makes it very hard for your first time home buyer to compete
Yeah.
in that space, especially if they're offering cash, if they're using any type of down payment assistance. And it's just not a level playing field, I feel like, in many instances, because the average, first time homebuyer cannot, they can't compete with cash unless you just have a seller that has a heart for, for first time home buyers. It's very hard to walk away from that, 10-day close, and it's a cash offer.
Yes.
And I feel like we get, a lot of it, we get left behind. We don't have the potential for ownership there. It's because we don't have the resources to be able to compete in that space. And it's just very disheartening to see, because we have, during COVID, when it was at its highest, our rates of home ownership went down
Yes.
in many communities. It
Yes.
went down.
Yeah. Well, well, ladies, listen, I want to thank you for joining me this evening to get our inaugural, Savvy Homeowner series kicked off. I want to thank you for the topics and for the information that you provided to everybody on the call tonight. I do want to just say, are there any questions between us that anybody might have? Now's the opportunity to ask any additional questions. Um, if not, what I do want to do is just let everybody know that this is going to be an ongoing series. We're going to try to do it the fourth Monday of the month at the same time at 6 o'clock on a Monday evening. And so I hope everybody will stay tuned. I don't have the topic yet, but I think I'm leaning toward a topic, but I'm not going to say it tonight. But that's going to be on March the 25th. And again, that's going to be on a Monday. I would ask that everybody go ahead and follow us on social media. A lot of the information I'm going to be pushing out is going to be through Instagram or Facebook or Nextdoor, and everything for us can be found at New Legacy Realty, and that's NEWLEGACY Realty Realty. So make sure you're following us on those sites. And the other thing I want to do right before we leave is just kind of share our screen, because I want everybody to make sure that you get the information for our presenters tonight. So let me see if I can get to the screen. There we go. There's everybody's information. So if you would, please go ahead and take a screenshot or take a picture, and that way you will have information for Karen Boone, our agency owner with State Farm. Thank you again, Karen. And Yvette Carpenter, our Vice President Retail Mortgage Loan Officer with Truist Bank. Thank you again, and myself. So again, I want to thank everybody for tuning in, and we will see you the next time on The Savvy Homeowner.
Thank you for having me.
Thank you for
Thank
having
you.
me, Cheryl.
Thank you.
Everyone.
Good night.
Bye.
Good night, everybody.
Good night.